I am going to deal with Indian Accounting Standard 1. This standard, as you may know, provides valuable guidelines for the presentation of general purpose financial statements. These statements will include balance sheet, statement of profit and loss and other comprehensive income, statement of changes in equity, statement of cash flow, notes. Let us now examine these items one by one. Let us start with the balance sheet. The balance sheet of a company shows its financial position on a particular date. Under Indian AS, assets, equity and liabilities of a company should be presented in that order in a vertical format in the balance sheet. We will now have a look at a balance sheet under Indian AS 1. Balance sheet as on 31/3/2022. Note 2021-22. 2020-21. We will have to give the figures for 2 years. Assets. Non-current assets. Property, plant and equipment. Notice 1. Figure for 2021-22 is this. 2020-21 is this. Intangible assets. Notice 2. Figure. Financial assets. Investments. Notice 3. Figure. Loans. Notice 4. Figure. Total non-current assets. Total for 2 years. Now current assets. Under current assets come inventories, stock in trade, trade receivables, bills receivable, cash and cash equivalents. You may now be wondering what is the difference between inventories and stock in trade. There is a clear difference. These represent raw materials purchased by a company, work in progress and finished goods of that company. Stock in trade, on the other hand, are items purchased from other companies to be sold with their goods. Take for example iPhone. Apple manufactures iPhone. With iPhone, they supply charger. They will manufacture iPhone. So iPhone will come here, inventories. Charger will be purchased from a third party. So it will come here. Now total current assets. Then total assets. Total assets consists of total of non-current assets and current assets. After asset come equity and liabilities. Equity will be listed first. Equity consists of share capital, reserve and surplus. Then non-current liabilities. Under non-current liabilities, financial liabilities will be listed first. Long-term loans and other long-term liabilities are financial liabilities. I have explained these two in my previous lecture. Now deferred tax liability, then long-term provisions total. Now the last item in the balance sheet, current liabilities. Under current liabilities come financial liabilities, trade payables, bills payable, short-term provisions. Total of current liabilities. Then total equity and liabilities. Total equity and liabilities are shareholders' funds plus non-current liabilities plus current liabilities. The total assets should be equal to total equity and liabilities. Let us now take a look at a note on property, plant and equipment. All notes will be numbered to distinguish one from the other. Notes are required to be incorporated into the financial statements in order to give the details of assets and liabilities shown in the balance sheets. Property, plant and equipment will come under note 1 because this is the first item to appear in the balance sheet under non-current assets. Note: property, plant and equipment consists of all tangible assets like land, building, plant and equipment, motor vehicle, etc. They will be listed one after the other in the note. For the sake of briefness, we will just take one asset, that is building. So asset will come first, building and total. Gross value will be shown first. Under gross value, balance on the first day of the year will be shown. Balance on 1/4/2021, 126. Total will be 126. There were no additions during the year, so nil. Similarly, there were no disposals in the year, so nil. The total will be 126, total will be 126 here. Now depreciation. Balance on 1/4/2021. This is the accumulated depreciation up to 1/4/2021. It was 4. Charge for the year, that is current year's depreciation, 2. There were no disposal, so no details. Balance on 31/3/2022, 6. Now net value. Net value will be gross value minus accumulated depreciation. In the case of asset on 1/4/2021, it will be balance on 1/4/2021, that is 126 minus accumulated depreciation up to 1/4/2021, 4. So the gross net value will be 122. Similarly, net value of asset on 31/3/2022 will be 126 minus 6 is equal to 120. Property, plant and equipment will be followed by intangible assets. They are mainly patents, trademarks, copyrights, computer, software. The note on property, plant and equipment was note number 1. So quite naturally, note on intangible assets will be note number 2. They will show patent, trademark, computer software and total. This total will come in the balance sheet. Financial assets are next. They will comprise non-current investments, loans. Non-current investments are investments in subsidiaries, associates and joint ventures. Loans are those provided to investee companies. Note will be 3 and 4 respectively. Note 3 will show details of investment in subsidiary A, amount. Investment in associate B, amount. Investment in joint venture C, amount, total amount. This total will come here. Then loans, note number 4. Loan to subsidiary A, amount. Loan to associate B, amount. Loan to joint venture C, amount. Total amount will come. We will now go straight to the last 2 items under current assets. Item number 1 is cash and cash equivalents. Item number 2 is bank balances not included in cash and cash equivalents. Under cash and cash equivalents will come cash in hand, cash at bank, bank deposits maturing within a period of 3 months from balance sheet date, and bank balances not included in cash and cash equivalents will consist of bank deposits maturing after 3 months but before 12 months from the date of closure of books of accounts. No separate note is required for equity or shareholders fund because the information required is given in changes in equity. We will therefore move straight to non-current liabilities. Under non-current liabilities, first will be listed financial liabilities. Under financial liabilities, long-term borrowings. Long-term borrowings will consist of long-term loans from bank and debentures. They are payable after 1 year. Other long-term liabilities will include intercompany borrowings payable after 1 year. Then deferred tax liability. These are, as you know, time differences. Long-term provisions for possible long-term payments. Having done with the balance sheet, we will now move on to the statement of profit and loss and other comprehensive income. We will start with profit and loss account. Revenue, sales. These are income from operations. Other income. This is mainly gain from sale of fixed assets or short-term investments. Total revenue. Expenses. Raw material consumed. Change in the inventory of finished goods and stock in trade. This is the difference between last year's inventory and this year's inventory. Employee benefit expenses. All payments to employees in the form of salary and other benefits. Finance cost. Interest, etc. paid to the bank. Depreciation. And other expenses will include rent, printing and stationery, etc. Profit before tax. This is total revenue minus total expenses. Then tax expense, current tax, deferred tax, profit after tax. Now we will examine other comprehensive income. Statement of other comprehensive income, OCI. There are two types. One type is items that will not be reclassified later into profit, net of tax expense. Item A, gains or losses arising from revaluation of tangible or intangible assets, or in other words, revaluation reserve. Remeasurement of defined benefit plans. These are the employee plans for the long-term benefit of employees, like pension plan. Now, items that will be reclassified later into profit, net of tax expense. 1. Exchange difference on translation of foreign currency. B. Change in cash flow hedges. Total other comprehensive income. Then total comprehensive income. This will be profit after tax plus total other comprehensive income. Statement of changes in equity. This statement indicates changes in the various components of equity during a particular year. What are the components of equity? Share capital, retained earnings, that is surplus, then various reserves like general reserve, capital reserve, revaluation reserve, etc. Then total. It starts with balance on 1/4/2021. That is the first day of the current year. Share capital was 1000. Retained earning was 2000. General reserve was 1000. Total was 13,000. Let us assume that there were no changes in share capital. Had there been issue of share capital or buyback of share capital, this figure would get changed. Now, dividend paid. Company makes payment of dividend afterwards. 200. So the total gets reduced to that extent. Profit for the year. 1000. It comes to the total. Transfer to general reserve. Assume that it is the company's policy to appropriate 20% of profit to general reserve. So 200. It will be reduced from retained earnings and added to general reserve. There won't be any difference in total. Now total 10,000, 2,600, 1,200, 13,800. Next item is statement of cash flow. It shows the details of cash received and paid during a particular period. There are two methods of doing it. One is direct method and the other is indirect method. I am not going into details because commerce graduates even at undergraduate levels are quite familiar with them. Now notes. I have already explained what notes are. Before we wrap up, we will examine the salient features of a financial statement. 1. Accrual basis. Financial statements are prepared on accrual basis. This means all transactions done during a period will be recorded in that period irrespective of whether cash is received or paid. This gives a total picture of transactions. Now going concern. It means that the management wishes to continue the operations of the company on a long-term basis and that it has no plans for closure in the immediate future. Financial statements of a company is used by a wide variety of people who take decisions based on the statement. So it is necessary that they should have some qualitative characteristics. One is understandability. Layman with a modicum of knowledge about business and economics should be able to understand it. Then relevance. All the information provided should be relevant to decision making. Then materiality. These statements should be free from material misstatement or omission, or else it will lose its relevance. Then comparability. Usually information for 2 successive years are given. So users can compare the performance of a company for these 2 periods. Similarly, comparison is also possible with financial statement of other companies in the same industry. This academy designs its courses with the aim of providing maximum benefits to students. Suggestions for improvement are always welcome. The success of our course will depend upon your wholehearted support.